Today, I'm fortunate to have three of my members and fellow officers with me. Dean Austin is a former president of the Society and a graduate of Clark Atlanta, MBA. Now, Dean is going to talk about what to do with your money once you've saved it.
Okay, so here's some of the keys to compounding. Letting dividends and interest reinvest. So when you buy a stock, when you buy a bond, and you have income that is being generated by those investments, the key is not to take it and spend it, right? It's to take it and plow it back into that investment. So you have that in addition to the compounding that's taking place. Again, very powerful, right? Fees eat into your results. 7.5% average return, so 75 basis point fee is a 10% drag. Any amount of fee is a drag. Have you guys heard about this whole debate in investment called active versus passive? Are you familiar with that? Okay, so you have the passive funds, which are ETFs in general. They're very, very cheap. The whole idea is the smart guys really can't beat the market over a long period of time. So why pay them extra money on top of the actively managed funds that they're managing for you? Why pay that extra fee? The best thing to do is just throw it in an index fund and just let the market rip for the next 30 years, right? So when you have that type of mindset where it's really low cost versus high cost, it's really not active versus passive, that's when you get into the situation you're realizing that fees are really, really important as far as investment returns. They're going to eat away at your returns over time. The same holds true for taxes. When you are in there trading, I know you might think it's very sexy to be a day trader and be there sitting and watching the market and moving in and out of positions. That's tough to do. You have to sit there and watch the market for a very long time throughout the day. It's not a fun job whatsoever. I've never done it, but I don't think you would enjoy doing it. So you're basically tied to your computer, just kind of like gamers. They sit there for hours and hours and just do that. That's what you do, watching and trading in and out. But guess what? When you do that, the IRS is going to come and get you for a little bit more in the short term than they would in the long term. So keep that in mind. So the whole thing is to be long-term focused. But number one, always set aside that money in an emergency account. Okay? Because no matter what, at the end of the day, if something happens where either you fall ill, there's an unexpected car repair, home repair when you become homeowners, kids when you have a family, you want at least 4 to 6 months of money set aside. And there's even another word for that when you get into your investment portfolio, and it's called your sleep well at night money. So you want that. If you remember the 2008 crash, okay, the housing crisis, remember that? Okay, that should be pretty fresh in our minds, right? Okay, so imagine if you're a regular investor and all of a sudden you saw your portfolio dip by 40, 50%. I know that year, I believe the S&P went down about 37.5%. Okay, so imagine if your portfolio went down by that much. What would you do? What kind of reaction would you have? You'd want to get the heck out of the market, right? And that's the reaction to really react to the situation rather than maintain your discipline. And what you end up doing is what? Selling low and buying high. You want to do the exact opposite. You want to buy low and sell high. Okay? Let's go to the next slide. Okay, what we've kind of provided here is really just a chart that shows all of these different things that you might want to do throughout life, these different goals, and how they're time dependent, right? So a new car account, rainy day account, as you move from left to right, you're going to have to think about, okay, how do I invest that money? Or maybe I don't invest it at all, because it's all about the liquidity, right? The being able to get to that money. Liquidity is all about being able to get a good price for, or fair price for that instrument that you want to sell at the time that you want to sell it, right? So you have some very liquid assets and very illiquid assets. So as you go from left to right on this chart, or this graph, I should say, then you have to think about your goals and how you need to invest for those and the time frames that's required to meet those needs. So what we've done is we've put this in a nice little continuum here where you have rainy day account. I mean, in your rainy day account, are you going to invest that in the stock market? Probably not. And because of that, you're going to have some very low returns in that checking account that pays next to nothing, right? But the risk is also very low as well, as it should be. But as you go further, excuse me, to the right, then you start pushing out that time horizon, and now you have to think about, okay, these are some big ticket items. These are some things I need to start saving for now to be able to pull money in later on. So I need to think about how I'm going to structure my investments and understand again that this is not something where you're going to accomplish in a day. It's going to take year after year after years of disciplined investment in order to get to that goal. All right, so this is, have you seen the Efficient Frontier yet? You familiar with that? Okay, so this is what we would call an efficient frontier in the investment world. And you have risk and return that's graphed here on the horizontal and the vertical axis, right? And you know, growth assets and defensive assets, they combine in portfolios to achieve certain results. You just don't have all growth, you just don't have all defensive, because you're probably not going to get to that needed goal. There's also things that you look at as far as active versus passive. Even in portfolios in the asset world, there are some large cap areas as opposed to maybe large cap areas as opposed to maybe another area of the market that may not be as efficient as a large cap space. You may decide, you know what, it might be better to be active there rather than passive, so you can mix that within the portfolio. So as you go from left to right, you can see that you've moved from fixed income assets like bonds that are more defensive to growthier assets like equity and stocks and property, real estate. You know, in Georgia, this is where a lot of the wealth was created, in real estate, right? So that continues to this day, even after the hiccup that we experienced in 2008. So what you have to make sure is all of these things are in place within your portfolio when you structure that. And again, investment versus trading. I don't know if how many of you listen to CNBC and a lot of these shows. They talk a lot about, you know, what's going on in the marketplace and how to position portfolios. But a lot of the audience that they're speaking to, and you don't really realize, are the traders. It's not the long-term investors who have a 20, 30-year investment horizon. So you don't want to react to all of those different comments. That's what you call noise within the marketplace, and you want to block out that noise. If you put a disciplined program in place, none of that is going to matter. Now, what you want to do is structure your portfolio so there's not only the long-term aspects that it's achieving, but because within the short term, there are going to be opportunities, right? So there you need to be a little tactical. You want to be a little nimble. That's where the trading comes in, but you're still not trading in and out of something on a daily basis and generating taxes. What you're doing is you're getting into that position. It might be a 6 to 12 month, horizon, maybe even 18 months, whereas your strategic objective is more on the order of 3 to 5 years. Does that make sense? Okay, let's go to the next slide. All right, so let's look at some returns of the different benchmarks here, 25-year returns, and this dates from March 1992 to 2017. And they have the S&P 500, which is your large cap index, the Russell 2000, which it represents small caps, IFA, International Developed Emerging Markets, all the way down to cash. And as you can see, cash has not been a very good return at all. Now, there was a time where you could get about 5-6% in cash, right? Those days are long gone. Maybe they're coming back a little bit later on, but not right now. So what you find sometimes is we, as a people, we tend to be a little bit too defensive sometimes and too conservative and have our money in cash, have our monies in the mattress, those sorts of things instead of investing it in the market. And as long as you have a plan, you can step out on the risk spectrum a little bit and not be in cash, because cash is not going to get you from point A to point B. Okay? Okay. And here is the retirement pyramid, and all really this is illustrating is the fact that during those years, there are so many different areas that you need to think about, within your bucket. You have your Social Security bucket of your annuities, where those things are guaranteed. Although we don't know so much about Social Security. They keep talking about that, but we'll see if it's around by the time we get through with it, okay? Right? There's a reason why we're a little bit older, right? There's got to be a little bit of benefits to that. But anyway, long-term assets, your real estate, your 401ks, those are things that you've been contributing to. 401ks, IRAs, those are qualified types of investments where you can contribute money to that before tax. And then when you take it, grows tax deferred, and when you take it out, that's when you're actually taxed on it. Insurance, we tend to ignore this a lot. But even though we're living longer as a people, you have to understand too that there's a lot of different ailments health-wise out there. And what really is the big, I think, the big thing that upsets the apple cart for individuals, that are retiring, is the fact that they have an illness and that requires a lot of money. They're not able to pay for that. So let's go back to just that last slide. And what this is us telling you is, here you are is a life cycle of what's going on. We all go through stages in life, right? In our 20s, 30s, 40s, 50s, we all want different things and need different things. Whether we're single, we have families, we're straight out of college. I mean, you have to plan appropriately for those. Although, there's a saying that, I'm sure you've heard that saying by Mike Tyson, everybody has a plan until you get hit in the mouth. Okay, so that happens when you have to shift and be a little bit dynamic. Don't be rigid in your plans, but understand that they are life events that cause your plan to change. So keep those in mind, understand where you are in that life cycle, and enjoy it. Know that there are going to be challenges along the way, but just keep your head. Next slide. And just to summarize early, I think one of the biggest things that you can do is to understand that you need to start early. Have a plan. You can't get from to your destination without a plan. The diversification, that's going to smooth out your ride. It's not about having the best return. You can have two different buckets of portfolios. You can have two different portfolios, portfolio A and B, and over a 20-year time horizon, both of them has experienced a 10% return. But if one has had more volatility than the next, guess which one is going to have the higher terminal wealth value? It's going to be the one with the lower volatility. So that's what you want to focus on, right? Always think long-term versus the short, because again, we're not in a hurry here. We have plenty of time. And take advantage of your 401k match. All right? Thank you very much. I'm going to turn it over to Justin, and he's going to talk about living with less, which is very important.